What's going on today, everyone? And I have a question for you. Would you like to get paid upfront to buy stocks that you already want to own at a discount? Well, if the answer is yes, and it sounds too good to be true for that offer, it's not. It's called cash secured puts. And today, I'm going to delve deep into those, which is going to unlock for you the secret of consistent income and getting the stocks you want to own and becoming financially successful and independent. Sorry if I'm getting a little too excited, but these are all beautiful things, and you're going to get them all for yourself soon. If you like that, stay tuned, enjoy the video. Let's get right into it. You're probably asking yourself about right now, what is this said cash secured put? A put option gives the buyer a right to buy a stock at a certain price, which we call the strike price. When you sell a put, you're agreeing to buy the stock if it drops below your strike price. The cash secured part means that you have enough money set aside to buy all of those shares if it does fall below your strike price. Why would you use this strategy? Well, you get paid the premium up front, which means you can use that for other opportunities instead of having your capital tied up. You have the option to buy the stock you already want to buy at a discount, and it's actually a lower risk than buying 100 shares of the stock outright. The big risk of this strategy is that if you pick a stock that you don't want to own, you could potentially buy a lot of shares of that company and it can never come back up to where you wanted it to be at originally. In other words, if it crashes, you're going to have to buy at your strike price 100 shares. And if it's a crappy company, you won't be able to get really any hope of ever receiving your money back. That's why we choose good companies that we want to own anyway. And this strategy works wonderfully. In order to give you a good understanding of this strategy, I do have to go over one definition very quickly, so bear with me. Implied volatility. What implied volatility is the market's explanation, or expectation rather, of how much a stock is going to go up or down. Think of it as if the stock is a line and there's two bands that are around it. These bands will either expand or contract based on how wide the stock will move. The more volatile a stock is, in terms of if it goes from $10 to $5 to $15 on a given day, or if it just bounces around 10 to 11 to 12 and back to 10, it'll be more volatile. And the more volatile it is, the higher money we'll get in premium for selling these options to other people, because it has a higher expected chance of moving. So they have a higher expected chance of making money, and we have a higher expected chance of having more risk on our end as the sellers. What's this? Oh yeah, it's an iPhone 16. And this is a product that's made by Apple. Apple is a huge company that I think has very little chance of going away anytime soon. So with that being said, let's go ahead and look at how this strategy would work on a stock like Apple. So we wouldn't mind owning 100 shares, would we? Now that I've decided that I want to trade Apple as my stock for the cash secured put strategy, I have to decide how far out I want to trade. Options generally go weekly to monthly, up to about 2 years. So the farthest you could do one is about 2 years out, and for most cases, 1 week out is the shortest time frame. Generally speaking, 30 to 45 days is what you want to aim for the best ratio of risk to reward. Also, if you're a degenerate and you want to just keep compounding all your income and adding it on top of each other and growing it, you can try weeklies, but monthlies, 45 days, gonna be a lot more consistent. So let's say a month and a half. Now, how would I go about setting this up, right? What we're gonna do here is we're gonna go to a nice time frame where we could see a decent amount of action. Let's look at 30 minutes, right? And we'll just sort of look at the last couple months of this year. We'll go ahead and take a indicator. I like Bollinger Bands. I think they're a very basic strategy, and they kind of go in line with what I was saying earlier about having a strategy that shows the implied volatility. Remember the definition we just went over. So for this particular instance, it's actually a good time to sell this strategy. And let me tell you why. Because if you see the Bollinger Band, it's going to be the red and the green here. The red is resistance and the bottom is green, which is support. So we can see it's closer to the bottom of support Also, we can see on the RSI here to confirm that it's closer to the bottom, which is support, which means it's more likely to go back up to here, right? So, since it's in such a nice position on the chart, it's a solid company, we don't mind owning it, we can go ahead and just say, all right, let's do the bottom of the Bollinger Band. Or you know what? I want to be a little greedy. I want to be a little safe. Excuse me, not a little safe, a little risque. And do 238, right? So let me go ahead and visualize what this contract would look for you, because I don't know about y'all. I'm personally a visual learner, so I like to use this great tool here, Option Strat. And you can actually build out this strategy. So we're going to select cash secured put here. We're going to type in Apple. And we said we'll do 30 to 45 days. So let's do 50. Why not? That's on the farther end. I like it. And we're going to do, I wanted to do 238. I think in the weeklies you could do 238 or 237.50. But for the this far out, it's a little different because there's not as much volume. But that's okay. We'll just do 235, right? So for a safe stock like Apple, let me go ahead and show y'all one thing here that you must know as well. Market Chameleon. This is a pretty cool screener for options specifically that actually has the IV on here. So you could actually see the implied volatility before getting into one of these trades. So you can see here, it's moderate. It's moderate. 24 implied volatility. So that's good. I mean, it's Apple, right? It's not going to be all over the place necessarily, but it's enough to make some money on. So how much money is this? All right, let's check it out real quick. Calculator. So we're doing 50 days for 23,500 cash up front. And we're going to go ahead and take that number. We're going to divide that into this number, which is our premium we collect. So that'll give us the percentage of return. So we're going to get 2.4% return in 50 days. Now, that is if it stays above our strike price of 235. We just get to keep that 2% free and clear. We're done. The trade's over. We can do another one, right? If it falls below 235, here's where the interesting thing gets kicking in. We have to buy 100 shares at 235, but we get to keep our premium. So we're actually getting the stock shares for 229.23. That will be our break-even price. So this is a great way to make your way into a stock like Apple that you already want to own and establish a position over time, because you're actually getting paid, like I said, to buy the stock where you wanted to buy it already. And it's a stock you want. You can calculate your risk. You can get paid. It's awesome. Just to reiterate, the two possible outcomes for this strategy are the stock stays above your strike price, you keep your premium, and the contracts expire worthless. And the second is the stock falls below the price and you get assigned the shares from your contract at the strike price that you agreed to pay for them at, still keeping the premium. So either way here, you're keeping the premium, which is money. Now here's something that I like to look at when I'm feeling a little crazy, all right? This is the implied volatility ranking screener on Market Chameleon. So these are the most, well, you can set it to be the most highly implied volatility stocks in the market. So how you do that is you go here and you click, let's see, I believe the relative one is good. You can do this one though, implied volatility here. So one thing I like to do if I'm trying to find something is I'll go ahead and do, let's say over 1 billion, right? So, and we'll say over 5 billion. We'll say we want to only look at the big guys, and we want a volatile stock. That's the big guys, right? So Here we can see Rocket Lab. This is a really popular one. You know, they launch rockets similar to SpaceX. We see Robinhood, which has had a lot of moving around lately. They're pretty volatile. We have Reddit, which has fallen from 200 to 168, which is also quite volatile. So this is a little list of some of the big ones that we could actually make a pretty good amount of premium on doing. Just some food for thought. I like to go through these lists and I'll go ahead and see what I see. We got Reddit right here, like I said. We have Robinhood. We have Snowflake. They're pretty cool. They do cloud services. We have Rocket Lab. So, you know, don't overcomplicate things. We even have Dell here. Just look through this list, and if there's anything that you want to own and the volatility is high enough, all I'm saying is instead of just buying shares, maybe you consider selling an option. Maybe just try it out. Maybe you'll make a lot of money doing it. Maybe it's not for you. You gotta try. You gotta mess around with these things. You know, Roku's pretty cool. They got movies. Who doesn't like movies? Lyft, the competitor to Uber that hasn't quite hit their stride yet and making money. So yeah. The final thoughts. Final thoughts. Let's go over a couple of the risks. So the risks I would say with this strategy is you really want to have a solid awareness of any potential news that could sink the stock or any potential earnings coming up. So let me give you an example real quick of where it would be really bad to do this. So Hims, for instance, they just had news drop here that one of the drugs that they had access to for Ozempic, a weight loss drug, became widely available, right? So if you had sold a put for $70 when it was at 71 and then you woke up the next day and it was at 41, you could have a pretty big issue on your hands. You could have to buy 100 shares at $70 when it's now trading at $41, right? So with that being said, you know, use some common sense. You might still be fine with that. You might adjust accordingly. Maybe 100 shares of Hims is nothing to you. $4,000, nothing to you. You got $1 million account. You're gonna sell 10 more once it gets down here, and you sold 5 up here. So it doesn't matter for you. You're gonna average down. But again, it's just something to be aware of. In terms of, you know, I just said you have a $1 million account. Make sure you have enough cash to buy. Some brokers will let you use margin, which is borrowed money for this strategy, and that could be a big no-no because if you don't have enough cash to cover these puts and it lets you anyway on margin, which is house money, and it does drop crazy like this, they can actually sell it for you. So you won't have control over when you sell your own position. That's why I always recommend to beginners, do not have margin on as an option at all if you don't understand the concept of it.